What is your goal, financially speaking, for retirement? Most likely, it's to make sure that you're able to have enough money to last through your retirement years while living the lifestyle that you plan for. Sounds pretty straightforward, right? Where it gets complicated is negotiating between equally but valid conflicting concerns with your money in retirement. Number one, you have the need for safety and principal preservation. I mean, you're not putting more paychecks into your retirement accounts, but also the need for growth to hedge inflation and other unexpected costs during retirement. So how do we balance these two concerns? That's where I have Ryan Marston of Rubino & Lang Wealth Partners on with me this week to discuss. Welcome to After the Paycheck, the series dedicated to helping people to and through their retirement process. I'm your host, Adam Bly. This week, I am here with partner at Rubino & Lang Wealth Partners, Ryan Marston.
Pleasure to be here with you.
Good to have you here. It's very formal.
Yeah.
And this week, we're going to talk about why your retirement portfolio strategy needs to be different than when you were working, and how mentally to make that adjustment before retiring so you can help maximize your probability of success in retirement.
Yeah, a great topic. I think it's a common question or like unknown to some of the people we sit down with and talk to about really what the difference is and what changes that they have to make mentally going into retirement.
Yeah, I think that, like you said, mentally, I think there's a big disconnect between that, and we're going to get into that with that, you spend 40 years of your life working for,
Sure.
This, whether it be a various amount of companies or this, that, the other thing, and then all of a sudden you're just done. And it's like, how do you mentally prepare for that?
It's tough. You've been saving these entire, 30, 40 years, however long your working life was, into these retirement vehicles. You just plow as much money as possible into it, hopefully get some good returns with the market, and all of a sudden it's built up to X amount of dollars. And now, what do I do now? Like, what can I take out of the account? Like, where do I go from here leading into retirement?
Right. So let's kind of get into, to move this forward into what those two mindsets are. You have what you guys call two different phases of your I don't want to say your life, but of your years, right? There's accumulation and then decumulation.
Yeah, exactly. So the accumulation phase is during those working years, right? And not only, again, are you putting money in, and hopefully maybe your employer is actually matching some of that money you're putting in,
right.
But you're getting some growth on the accounts as well. So the assets are accumulating, and you're really just worried about growth because you're not taking money out unless it was like an emergency or you needed a 401k loan or some other reason.
Right.
But you're not taking money out of the account. And then all of a sudden, as you're getting closer to retirement, it starts to, it should be, the mindset needs to be changing a little bit. And how do I gear up for that decumulation phase? And I'm going to be withdrawing money from this account. How do you position the account? Because it should be actually a lot different than that accumulation phase, how you position assets in the retirement accounts for the decumulation phase.
Right. We spend the majority of our lives thinking we need to grow our assets, and we're always going to consistently have that paycheck to just, again, add into that account. That when you have to shift over to that idea of I have to spend, is there a point where a person has to, again, mentally come out of that idea of, hey, I'm not going to see this money grow as much anymore? There's going to be negatives out of it.
There could potentially be, right? So, I mean, you can't get into as much trouble on the accumulation side.
Right.
Because even if you're having a bad market year, you're plowing money into it. That's offsets some of those losses, and you're actually dollar cost averaging into the market, getting better growth on the money you're adding when the market might not be doing as well. But on the decumulation side, you can actually run into a lot of more issues potentially if the account's not, or your retirement accounts aren't properly set up. If it's too risky and there's too much volatility, or you're drawing down too much, which we can get into. Yeah,
that's actually what I want to get into.
All right.
So understanding that, okay,
Perfect.
I'm going to be making withdrawals because, again, my paycheck is now what my 401k accounts or what my retirement portfolio is. Is there a point where I'm pulling down too much, and how do I know what that balance is?
So potentially, right? So if using a couple examples, or an example is, let's say you had an all stock portfolio going into retirement. Mm-hmm. I mean, obviously that'd be a little bit aggressive, right? Okay. And there could be, and you're drawing 4% from the account, okay? You have a 4% withdrawal strategy. So you have $1 million, it's in all equities, and you're taking out $40,000 a year. Well, what happens if February and March of this past year, the coronavirus bear market issue, and happens, and you lose. If you had an all stock portfolio, you could have lost upwards of 30% in that few week time period. So now you no longer have that $1 million. You have $700,000, but you're sticking to the 4% rule. Well, 4% on $700,000 is a lot different than 4% on $1 million, right? So you're gonna have to adjust your expenses or budget, and I don't think anyone really wants to do that. And that's the issue you could potentially run into with having too risky of an account or retirement accounts heading into retirement.
Okay, so this kind of goes back to what we were talking about before about that balance between that safety of having that money that's going to be available to pay those expenses to keep the lifestyle that you want. I don't want to eat peanut butter and jelly sandwiches every day just to.
They're okay every so often, right? But you don't want them every day. Yeah.
Right, exactly.
I know when I eat one here and there when I'm giving them to my son. So.
yeah, Daphne won't eat half of hers, so I'll eat the rest of it. Kind of a thing. Yeah. But it's also, again, like you said, let's say if I have all of my money in this particular equities account, that's probably not a good strategy to be in. I
think it's a very risky strategy. So you want diversification. Not only people traditionally, they might have a different mindset of like what diversification is. And, you have different stocks or different asset classes, whether it's financials or healthcare. But we want diversification of accounts too. Right. You need accounts that are more stable while you're drawing them down. You need income-producing accounts. There's nothing wrong with equities, but equities should be designed to keep up with growth, inflation, unexpected costs that might come down the line in the future. Right. But that's more long-term. So people can have the few bucket strategy, and for the short term, you might have a fixed income or an annuity that produces some sort of income stream that is going to be stable, less volatile than what that equity was. So you don't, if February and March happen, you don't have to all of a sudden take a pay decrease and live on even reduced expense or budget scenario.
How do I start to calculate like what that balance would be? I mean, you and I actually often bring up in previous episodes the need for understanding what your budget is. Yeah. But how do I then understand what my balance should be between what should be in those more, I don't want to say safety vehicles, but like those more fixed assets?
Yeah. In this part, like if you're going to structure it that way, I always look at like the next 1 to 5 years as short to intermediate term. Like you don't want the money that you're going to need for the next 1 to 5 years to live on from your accounts in something aggressive. Okay. Because of the volatility, the markets potentially, and you don't. Again, if you have a setback of 30% on like in the equity, say equity markets, and using very general term numbers here, but equity markets, you have 30% setback. You don't want to have to take a pay decrease. So if you have those in more stable accounts, whether it's fixed income or annuities that aren't going to be as volatile as equities, that's how you're positioning yourself so you don't have to actually make any changes or sustain any losses, because the losses would come on that more long-term growth-oriented stuff that you're giving it time to recover. Okay. All right? Because you're not reliant on that in the short term.
Okay. And I'm not, like you said, I'm also not withdrawing from it. So that's a smaller pool of money that has to work harder to grow to get back to that
exactly. So under that example, fast forward, market's done pretty well since that crisis earlier in the year. And if you didn't draw down from that, well, maybe you're recovered or close to recovering at this point. But if you actually start with spending down from that same account from February to now, you compounded that effect of that negative drop, and you probably haven't recovered since then.
Okay. So if I'm someone who is, let's say, within 5 years of retiring, so I'm still in this accumulation phase. Mm-hmm. I'm watching this episode right now, and I'm realizing, okay, there is a point where I'm going to have to start withdrawing from my retirements in, let's say, another pandemic or another market volatility correction thing happens. Mm-hmm. An event happens that causes this big stir. What are some steps I can do today to help balance myself so that way I'm ready and something like that?
Yeah, so if someone gearing up for retirement, 5 years is definitely not too soon to start looking into it. How do I position my assets? And at that point in time, you might not want to put everything into safety side yet, but you want to start de-risking your portfolio a little bit so you don't have the year before you retire, you're not and there's a huge economic crisis, and you don't want to suffer a 30% loss that's either going to delay your retirement now or,
Right.
again, reduce expenses. We keep going back to that. No one would want that. So when you're within 5 years from retirement, you want to start looking at the amount of risk your portfolio is taking on. And really analyze that and start de-risking it. And you can do that through the balancing of the funds you're using,
Okay.
or in taking some chips off the table.
That was going to be my next question.
Yeah.
If I'm just, Joe Schmo who works as a marketing guy at some company and I don't know what de-risking or balancing is, how do I know where to do that or who to talk to make sure that that's happening?
Well, I mean, you can always reach out to someone. I would always say you can reach out to us if you want to take a look at the amount of risk your portfolio is taking on and see if it actually fits with where you are in your time horizon. Yeah. But, when you go into, like, you log into your 401k or your retirement vehicles, you can always reach out to them, I would say. And
Okay.
they're not going to give you something specific to, like, your retirement situation, but they can give you some information on your portfolio. But it's more than just that, right? When you're looking at it, you got to make sure the risk you're taking on fits what your retirement outlook looks like and what your needs are going to be in the future and how it fits in. So it's not like everyone 5 years from retirement should have the same risk portfolio.
Right,
Everyone's going to be different. So you really want to sit down with someone and go over your specific situation and how all your accounts filter into that situation.
Like you said, everyone's situation is unique. You were talking about, like, balancing and talking to people. If I had, like, a target date fund type account, there's pros and cons to that, right?
There are. Yeah. Target date fund accounts are, I was just talking about this the other day, and target date funds are good for someone that doesn't want to really actively manage their 401k and doesn't have someone that they can rely on to help them manage their 401k,
Okay.
right? So you're going to pay, if you're going to retire in 2030, you pick a 2030 fund, and they're going to de-risk that fund accordingly as you get closer to the finish line. But the problem is it doesn't necessarily account for market concerns, economic crises, and it puts everyone that's going to retire in 2030 into the same bucket too.
Right.
So maybe you're fortunate enough you have a pension and you're less reliant on these funds you have in the 401k. You might not want to be in the 2030 fund because it might actually be too conservative.
Right.
Conversely, like, you might need more conservativeness than the 2030 fund just because you're retiring. So it kind of, like, puts everyone in the same bucket, which I really don't like.
Yeah.
But it does help people on the other end with managing the actual portfolio that might not be as savvy as an investor. Yeah.
Gotcha.
Yeah.
So to kind of wrap things up here, if I am, again, within 5 years of retirement, I need to understand, mindset-wise, decumulation means understanding that there's got to be some balance in my portfolio, which means there's liquidity.
Sure.
There's that safety aspect where I can have enough money to pay those 1 to 5 year expenses that you said, right?
Yep.
But then also understanding that people live longer today. There's a longevity risk that people need to understand in their retirement, that while they're pulling down, there needs to be some monies that's generating enough interest
Exactly.
that is offsetting the other costs of living.
Yep. Yeah.
Okay.
There's, you should always have that safety bucket, which is like the liquidity, money in the bank. Emergencies happen.
Yep.
9 months to a year of expenses, roughly, or more if you didn't feel comfortable with just that. And then you have the income bucket, and then you have the growth bucket. And that's again a very general way of looking at it. But you need to break down your assets at least to, like, that sort of aspect.
Yeah. I'm not thinking that I'm going to be able to be the one picking, the stocks that I'm in at the time.
Yeah.
But I think you said it's very important to understand that just to have that mentality, just to be able to give yourself peace of mind as you're drawing down from accounts, because you're not replacing that money anymore.
Exactly. It's all about added peace of mind.
Added peace of mind. I like that.
Yeah.
Ryan, thank you very much for the time.
Thank you for having me.
Thank you. If you guys have any questions and you're not already at afterthepaycheck.com, head there now. You can fill it out on the form below at the bottom of the page, or you can subscribe to future episodes of After the Paycheck wherever you get your podcasts. Until next time, take care.